Good morning, traders. I hope everybody can hear me. Stelios,
Hello.
You hear me all right?
Oh, hold on. Cancel. Yeah, I can hear you fine. Let me just get rid of this. We're good. Welcome back, Cayman.
Thank you very much. It's been a little over a week. It's been a very active week, especially on the barbecue, restaurant, lunches, dinners, drinks side. Let me just kill my squawk one sec.
Did you also have a big beat in the non-farm barbecues?
Yeah, exactly. I mean, that was like unbeatable. Those barbecues and restaurants. Well, we went to a couple of really nice places actually, but now I need a holiday to recover from my holidays, right? And I need a diet session to get back to my earlier roundness. No, I didn't trade, Stephen. I didn't. Alrighty. Still, shall I grab
yes, you can take it. Yeah.
We run over a bit of news. We are starting the same.
Sure thing. I think Steve is going to join us as well.
Okay, great.
But it's definitely me and you at least, and maybe Steve as well.
Okay, lovely.
Good to have you back, Cayman.
Thank you very much. Likewise, good to be back. Good to be back with you still. Let me see. Where am I? You guys see the screen?
You can see investing.com.
Yeah,
the calendar.
That's the one. So basically, let's first. I know you guys have been talking about that in length. I reckon about all those, all what has been happening. But of course, the main event has been those non-farm payrolls coming out on Friday, which probably surprised the markets a little bit because we're still, if we look at the price action, we're still, it seems, in a market that is willing or wanting to see a slowdown by the Fed sooner or later, because the dollar as such versus the, let's say, the main currencies, take apart the yen, is not really taking a lot of advantage of all these moves, but let's of all these good news on the NFPs. But let's move over to what we saw on the docket. Not a lot coming out since the start of the week. Has it been reported? No, it hasn't been reported. We had a bit of a better than expected, I think, GDP out in Japan, but I just saw that on the Nikkei. Perhaps that was already last week as well. I might be wrong, but anyway, overnight, not a lot to really mention in the on the data front. We had a bit of a weaker. Oh, your GDP, your CPI came out yesterday, and it's coming off. It's coming off still.
I didn't realize, and I can't tell. You know, from the prices that we're paying, I can't tell that.
Yeah, when you fill up the boat, it's still costing a lot of money, right? Yeah. So moving on. We had a bit of on the Aussie, the expected consumer sentiment coming off relatively in line with the past one, but the business confidence and the business survey came in better than last time, so that's good news for the Aussies. We had this. And I think that is keeping the yen under the cushion as well. And I'll come back to the yen later because I think there's a lot of carry trade going on again when I look at the price action. This 30-year JGB came in like a full 11 BPs lower than where it came in last time. I've been reading somewhere that foreign investors are starting to pile in again into Japanese bonds. I find it a little surprising, but could it be that they think that the whole card house on the yields market is going to fall apart, and they can buy some yen stuff again? Perhaps. I'm not 100% sure. I'm still catching up on everything that's been going on. For the rest, not a lot. Also the 30-year gilt auction, but it wasn't a big one, if I recall well. On the amount side, came in a full 15 BP, 17 BPs lower than the last one. Yeah, so some big moves. For the rest today, we've got the Mexican CPI coming in. Could be an interesting one as well, because Banxico has been ramping up interest rates of late. In a quite a fashion. That could have an impact on what Banxico is thinking about. Then we got some. Okay, I mean, for some it's of course very important, but I'm not sure whether this is going to be a market mover today. But we could see this. Perhaps the cost factor here could be a mover. I haven't seen productivity data really move markets for more than algo blips, so I'd rather watch this unit labor cost index coming out. And then looking further down the week, we have, of course, tomorrow's German CPI coming in. We already had the lender come in, and I think that was even before my holidays, where it was a mixed bag. So this one is going to be an open play. But usually when Germany makes a prognosis on their data, it rarely strays off far from their expectations. For those being in Scandis, we will have the Noki CPI tomorrow. We also have the Italian CPI tomorrow. One thing about the Italians, and I'm a little surprised it has not affected euro in any way, is that the center-left coalition has already fallen apart, and Moody's downgraded the Italian outlook.
You know why that is, right? Because we've had 150 Italian governments in the last 180 days. It's kind of the norm now.
Yeah,
sorry, years, not days, years. Yeah.
It's actually surprising when they do not have an election or anything going on over there.
We're not much better here in Greece, I have to say, but they lead the way.
Keeps you guys busy, right? Keeps you guys busy. And then tomorrow there will be the US CPI coming in, and that's going to be a big one, I think, especially that yesterday the New York Fed came out with a report saying that the inflation's expectations decline across all horizons. So the median 1 to 3 year ahead inflation expectations now declined to 6.2 and 3.2% respectively, from 6.8 and 3.6% in June. Any other given time, this would be like a really big move. They are still lofty levels, and but it might give the Fed something to think about it, especially after that monster. Okay, but much better than expected labor report that came out last Friday. Any thoughts on this one? Because the 5-year also came back from 2.8 to 2.3% in their report. So
yeah, I mean, first of all, the payrolls number, we discussed it last week. If you look at the details, it's not as healthy as as the number would suggest, the headline number. So there's a lot of second and third jobs being taken, and that's usually not for a good reason, right? You take a second job because you need the money to make ends meet. But you know what? This inflation print tomorrow is going to be very important, because the Fed has told us that this is what they'll be looking at, data, and how much more important than inflation. I mean, it's the most important piece of data at the moment, because that's what's driving everything. What do I think it's going to be? The market's actually expecting a slight drop, right, from last CPI year on year, 8.7, yes, from 9.1. I think that's probably fair. The risk is still for a surprise to the upside, but as we get closer, I said this yesterday, as we get closer to February, okay, we're some months away, obviously, but as we get closer to February, when things started to really move to the upside in inflation, we're going to be comparing to February 2022, right? Which is when the rate was going higher at a huge pace. So that by itself, and by definition, is going to be lowering inflation on a year-on-year basis. So we're going to see a drop, but we're not there yet. We need a few more months to see a considerable drop. And of course, the central banks are going to say, yeah, we made it. It was us. Our hiking has done this. But anyway, I think for Choice, probably a surprise to the upside tomorrow for CPI. But the other thing I wanted to mention is you did say very correctly, the market reaction, the dollar, after these payrolls, it was the exact opposite of what I expected. With such a strong headline number, you expect yields to go higher, which they did a little bit, the dollar to go higher, which it didn't. So the market is probably either very how do you say it, complacent, and everybody's on holidays, or the market's saying, we don't believe you, Fed, you're not going to be hiking much more than what we're currently pricing, and we are pricing 67, 68 basis points for September and another 50 by March. So we're pricing a decent amount, but the market is saying that's it, and you're going to slow down earlier than you're telling us. You're gonna pivot earlier than you're telling us. So what do I make of that? I don't know. It's a very tricky one. I think the market's right. The Fed will pivot, and the hiking will stop. But I think it's probably going to be a little bit further before they do that. So that's my view.
Yeah, the thing is, there's a as you can say, it's either complacent, either in holiday mood, or trying to look forward much further than today's market, and already thinking what's going to happen in 2023 and beyond, right? And that's where we see the large inversion in the yield curve, where that comes into play. It's really, if you look at the short end, I will look at it in a little while, but we look at the short end versus the longer end. I mean, I don't remember when the 2s10s were 50 BPs in inversion. I have hard time to recall when that happened last. It's a big inversion, right?
Yeah.
So the market is really trying to look, basically looking through what's happening right here and now, and then trying to figure out what's going to happen in a good while ago. But okay, let's move on with what else is going to happen this week. So we have the CPI. This is going to be important. Then we are having a lot of other components in the CPI. We have the continuous, the jobless claims as well. We have seen this thing crawl up and up and up. There's a couple of things I want to say about that. Is that there could be a delay, or there is de facto a delay between those initial jobless claims, which are creeping up, and the actual labor report. And I've also read a piece trying to catch up on everything that's going on, where companies are starting to say that the hiring process looks to be a little bit easier. That may be another factor which is starting to weigh in the future on inflation, perhaps. And as you say, that since people are having second and third jobs, that means that companies may start to find it easier to hire people, because the people are willing to take on extra jobs. It's not a great thing, because instead of creating new jobs, it's just the same people taking more jobs, right? But we'll have we'll have a close look at these claims as well, because they have been creeping up. So we're going to keep a close eye on that one.
Mark, if I may add one more thing before you continue. You were talking about the 2-year, 10-year spread and how it's inverted. Just to put things into perspective, if you go back to 1970, the only times when this has been inverted have been 1978 to 1981. That was very, very inverted at some point. Then you go to 1989. Then you go to 2000. which was, by the way, probably the last time we were around here at the 50 base points inverted. And then you got a marginal inversion in 2007. So what's the common point of all these? It's periods when things get very, very bad.
Yeah, exactly. Exactly. And yeah, thanks Nick for sharing, and thanks Simon on our chat room sharing a pretty. That's one nice chart over there. Yeah, so we are more than 20 years ago since that happened. But of course, I mean, in those 20 years, we had basically 20 years of liquidity injections, right? So that's been another factor. Okay. And then I see here the 4 and the 8-week bill auctions. That I'm not really looking at them because there's more like funding auction. But I'm seeing this 30-year bond auction coming up. What is going to be interesting as well to keep in mind is the U.S. Treasury, because as you all know, Biden succeeded to get a $430 billion Inflation Reduction Act through. That may I don't know exactly where U.S. Treasury stands at. I'll need to look it up because they have been reducing their bond auctions over the past months. But keep an eye on those because they might need to fund it. Although Biden is looking to up taxes on share buybacks and stuff like that. But we have to keep an eye on the U.S. Treasury going forward to see if they need to up their bond auctions again and up the amounts, which might put a little bit of upward pressure on the longer end of the curve. But that's music for later. And then moving on to Friday, last day of the week, we are going to have the second quarter UK GDP coming out. I'm sure you discussed it. POE, another dovish hike last week still.
Yes, you know what we were saying before the meeting, that the chances of a 50 are a lot higher than market thinks, and if that happens, it's going to be a short-term gain for the pound, which should be a really good opportunity to sell into. And it's exactly what happened. They're actually the first central bank that I can remember who are forecasting a recession. And a 4-quarter recession as well, 4 or 5, what was it? So it was a very, very dovish hike. Yes.
Yeah. Okay. So the expectations are for a slowdown. If I recall well, though, a couple of months ago, when we had the monthly, they had a bit of an upward surprise. So I'm not sure if we are really going to get if the month on month, of course, drops by more than 1%, this could go, the Q2 could go into recession as well, technically at least. But to me, this is a close call. It could come out either side just by a couple of tenths around the zero level. We'll have to keep a close eye on it. And since the market is expecting a negative number, anything positive may help the sterling more than if it's a weaker number, because the Bank of England told us that it's going to be a weak number, right? And so we also have the latest industrial production number, manufacturing production number. We have to keep a close eye on those ones as well, because they are going to be linked to everything that's happening GDP wise, right? And that is going to. Yeah, we have the Michigan. Powell also telling us to watch those Michigan data. They are expected to show a little bit of an improvement compared to the last time. But I think the consumer expectations here, what the consumer also think about the inflation, in line with what the New York Fed report was saying yesterday, that's going to be one to close the week on a possibly volatile note. So that's for what the data are. And then I noted a couple of other things. So the let me see what. How do I new share here? I'm going to move over to the.
Stop sharing and then
No,
share another screen.
unless you want to share something, I'm going to move over to the chart page.
No, I don't have anything to show really.
Okay.
No.
I'm just leaving this one on here right for now. The one thing that I've been noting here, and that's been coming back now. This is here in the bottom right hand corner. It's the Italian spread over the German spread. It's back. Hang on a minute. Here we go. It's back. It's come. No, that's wrong. There's a wrong stuff in there. Okay. But okay, it's after the spike higher at the end of last month, and then a bit of a spike here, start of this month. As you can see, I still have to update my my charts. It's capped around this around some moving average here around the 217, 220, and we're back around 210. As we know, for European ECB members and all other people looking at fragmentation tools and whatever, the 2% is their kind of pivot level to say things are going well or things are not going good. We stay above the 2% level, so it's still not great, but we're at least stabilizing. So that's that calmed down a little bit. Yeah, so we've been it's really the short end that's been ramping higher on the after the Fed. But then, as we can see, German rates short end have also been moving. We're still in this scenario where a lot of the major yields, ex yen, ex Swiss, perhaps, but a lot of the majors and the G7 or G11 yields are really moving together, which in the case of the euro is keeping this euro in a let's call it 150 160 points range between perhaps a bit wider 101 20 30 and 102 80 90 ish, and but we are staying away from big break levels right now. Is it a fact that we are just entering the holiday period? Possible. But is this market waiting for this CPI, waiting for clues on what's going to happen next? Is possible as well. And let's not forget that at the end of the month, we're going to have the intermediate FOMC, let's call it that way, when Mr. Powell will be in Jackson Hole. And we can have more news then about what the plans are. So I've been doing this. Yeah, for the rest of the news that I've seen, we had a pre-Pelosi scare in the yen, not knowing what was going to happen, and when the yields were coming off down to that 130. But now the market seems to be rather brushing off everything that's going on in the Taiwan Strait. Do you have any view on this, Stelios, or are we letting the politicians sort it out and the market not really reacting to it anymore?
You're talking about
the China, US,
yeah,
Taiwan.
Yeah, I mean that's. We've been saying that this is all a show of, it's theater, right? Well, mostly theater. Obviously, we were saying that about the Ukraine as well initially.
Yeah.
But this is much more serious, I think. This is potentially. So that's why I don't think the possibility of an escalation is high, because if it escalates, then the whole world gets in trouble. So I don't know. I don't know what to make of it. Unfortunately, I'm not involved in that. Fortunately, actually, I'm not involved in that in any way. So I don't know the details. I don't know what's happening behind the scenes. But for me, it looks like something that's going to blow over at some point, and we're just going to move forward and forget about it. But because it's been a story that's been going on for many years, right? And yes, there's always escalation every now and then. This happens, that happens, but I mean, I really don't know is the answer. I don't know.
Yeah. But the thing is that I had the impression that, of course, I mean, everybody has the right to do, and I'm not going to judge, but from a standpoint of an outsider, I had the impression that Pelosi,
yeah,
Pelosi just gave the Chinese a stick to beat Taiwan with. But then again, I mean, that's politics, and let's just not dig into that deeper. But it seems that China just picked up the gauntlet and said, "All right, let's show what we really mean." But anyway, the markets are not really reacting to it. I'm through whatever news or data that came out right now. I don't know if you want to add anything before I move on to the currencies and stuff.
One more interesting thing just to note, there's clearly still the race for the next conservative leader, Rishi Sunak and Liz Truss. And Liz Truss actually said something which was really right. And she's been, there's a lot of people fighting her over it. And she said basically that if she came to power, she would re-examine the Bank of England's target of a 2% inflation rate, because she thinks that the soaring prices of all the goods and services is because of monetary policy. And she says, the best thing to do is not target 2% CPI or inflation rate, but rather the money supply. And I'm like, bravo, this is really good. But she's had a lot of flack for that. Hello. Hey, Steve.
Which, by the way, I've explained multiple times how ridiculous is having a specific inflation target, right? That's positive, I mean. It's completely ridiculous, right?
Yeah.
And it was just a made-up thing so they can excuse monetizing debt as long as reported inflation was below 2%.
Yeah.
Right? Because if that was an actual target, and their worry only had to do with inflation, then if at 1.5% inflation they were worried about inflation not being a target, they should have been like 1 billion times worried with inflation being at 9 or 10 or 8 or 11 or 7%, depending on which country we're talking about, right? But for some reason, they don't seem to be equally worried when inflation is like 8% above target, than when it was 0.5% below target.
Yeah. There's a clear bias, and that's that's the way things are.
Let's say the good thing she brought up about that is to influence inflation by money supply, which is likely in current situation. I'm not going to say the best or the worst thing to do, but the more direct impact. It will have a very direct impact, right?
Yeah, the only problem is that when you're running huge deficits, you actually can't do that.
But deficits are okay right now. Come on, we are all in MMT, and you just didn't give a name to the baby. I mean, look at Japan, look at other people. I mean, that just exists to be forgiven at some stage, especially when you're a state, not when you're an individual. we have to pay our debts, but when are they going to pay their debts? Anyway, let's move on to the rates, a few price actions then. As I was saying in the room as well, this is the end of the July, and then since then we are just flatlining, within these 160, 170 points in the euro dollar. For day traders, we could argue that we've broken this little triangle here in the short term on the euro dollar. We're already stopping on a more medium term flip, but really it's going to be about first for starters 102.80.90 if we can get above there, and then which is more visible on the longer term, this 103.5. call it 50, 60, 50, 65, which is going to be much more important, I think, for the medium-term direction. And then we are not even talking about bigger zones around 106 or 108. For the time being, in the more medium term, we are still very firmly in a downward channel on the euro dollar. This is still a very big downward channel, and I really think nothing will change for the longer term for as long as we stay below 108. But we are likely trading holiday season now, waiting for data points to show us guidance. In the meantime, there's a couple of interesting option expiries today, which are around give and take 30 pips around the 102 in figure in the euro dollar. So come around 3 p.m. London time. If we are not too far away, the 102 figure 10 may perhaps attract a little bit later on. But yeah, for the time being, coming back from holidays, I don't really have a strong view on it at all. And I'm just looking at this. It's we are really range trading in this in a 160, 170 pips range right here and now. On the sterling, it's more volatile. But it seems that we are trying to we're trying to establish a range around the 121 zone. So yeah, around the 121 zone, it seems like we are trying to establish the range here as well. But basically, we are having a 121.67, and then above there 121.40, 40.60, which will be a trigger for moving higher. But I'm not sure if we have any strength to climb that high ahead of the GDP later this week. And inversely, 120.25. And then the prior low there around 120, the figure, and just below 120. I think we are going to be range trading in and this week there again, unless we get like big surprises on the dollar side of this pair when the US CPI comes out. Moving over to the dollar yen, that's been a bit wild in my absence. I left when it was around 133, around here, 133.5. Then we had this drop down to very rapid drop down to 130.40, which was then right on the well, the 100 DMA was like a little lower, but we came very, very, very close in testing it. We dropped actually through the cloud, but then equally rallied equally fast in a couple of sessions back to 135.75. This thing is volatile, and I reckon it remains volatile as well. And I think some has to do, of course, with the US yields dropping below the 270 down to 260s. Which we saw right here, nearly 250 on the 10s, which caused the dollar yen to collapse as well, because it's extremely tightly linked to US 10s, as we know. But then as the yields reversed, dollar yen reversed as well, and here we are back, and we are back where I would call it a bit mid-range of where we were in the past weeks. And this move up to 139.40, moved back down to 130.40, and then we are here in the middle of the range. I can't see too much to be done, although we have like a small level here already, 134.40 around. And I would say keep an eye on 135, high 135s. Yeah, prior high 135.60, which was a low here and then 136, which could propel us back into this into this channel if it would break. But as I said, I'm not sure at the start of this week whether we have strength to go anywhere significant, I would say, ahead of the tomorrow's US CPIs. Then let's move over to gold, to the metals quickly. Yeah, gold had a very strong recovery from that major 1670-80 zone, broke through a resistance trend line here around 1760 and is now trading and closer to 1800. I have it's 1800, 1805, I think, where the music will stop or continue to play. If we get higher, then we can make it back up into the 1825-35 zone again. But this top looks to me like it could be it for this move, and then we start to range a bit more depending on tomorrow's CPI. Everything could change after tomorrow's CPI, and then bottom end of this range for the next 24 hours, I think is going to be around 1770, 1772. That could be an interesting watch there ahead of the CPI, or at least a hold if you try to find the top and trade against the 1800. But I've got nothing running there. Silver has been doing nice things in my absence. I really liked it. Stelios as well is long. I reckon you still have them still.
Oh yeah.
Oh yeah.
Yeah.
So as the people will know in the room, I've been trading it in and out. I've always kept a very small long-term long, but I've added luckily around here actually on the second attempt. The first time locked some out. Bought again on the 1940s break, locked some out again, and so I've been building it up slowly today because I think there might be a bit of really decent resistance coming up between 2085 and 21. The figure today I've been just averaging, and I love the small out this morning just to improve the average on the whole lot. I might be looking to buy back around 2030 if seen, but for sure I'm going to be interested below 20 towards this 1960, 70, and this might feel a little bit low now. I think this could be a bull flag in the making. But I wouldn't rule out on any higher CPI print if they go for a retest, a quick retest down to 1965.80 perhaps. But we'll see tomorrow. If it doesn't, I'm already happy to reload around here the small piece that I've sold out today. Any more view on this still from your end?
Not really. I think the risk is CPI, like you said. I did on my longs from 1880, I did take a quarter off at 2040 a few days ago, and I was looking for 1940 to reload. We got close, 1950 something, and unfortunately didn't get there. But I'm still very bullish. But I fear that there might be another push lower if the CPI is strong, which means that the Fed's going to be hiking more, etc., etc. And we know the knee-jerk reaction is always for metals to go first. So, yeah. Okay. So I'm still very bullish on both metals, but with the gold silver ratio still up here in the high 80s, I very much prefer silver.
Yeah, the one thing that I was going to mention about gold and silver, of course, they are going to be impacted by inflation. They are going to be impacted by yields. But in Biden's climate and health and tax bill, I didn't see much about infrastructure. Has that gone completely out of the window?
I don't know, man. I don't know. It's
because that to me is really the card. If there would be more infrastructure coming in, that would be really the green light for silver to trade like really much higher.
in all these new technologies, in energy and solar and electronics. I mean, so much use of it, and it's still languishing around $20. It's amazing if you think about it, but it's gonna come.
Yeah, really, if we would see infrastructure and stuff, but actually, China is pushing a little bit on that front, and that may help silver as well. But that really, to me, would be the green light for much higher levels if the big blocks would really invest a lot in infrastructure. That would really be. For me, the green light for silver to trade higher, and likely the gold silver ratio then really starting to come off, right?
Yeah.
Yeah. Okay. Got a question on oil. Since I don't really trade it, I'm not really. I'm just watching levels really. But we've held. It had a quick look lately, but those are the CFDs, right? People are seeing different levels on different instruments. But we basically held the 61.8. We had a quick look a couple of times below, and now we are rebounding. This 87, 88 zone is going to be quite of importance. I also saw people talk about the 83 zone on oil, but that it might either be like forward contracts, future contracts, or anything, but it looks to me that we are trying to find a bit of a base here in this former congestion zone. As we can see, it's been a top. It's been wrestling around here. It's been a bottom here. It hasn't come too far from it here as well. So this 87, 88 zone is a bit important in my opinion. And then the top side, I think 95, 96 is where things happen to the top side for now on oil. But again, OPEC is running on autopilot, it seems. I've seen Goldman, was it Goldman or somebody else saying that they still think oil is going to trade higher because the supply is just not going to be there. But then I saw some different thing where Iran, or is it, may start to up their production and output. So it's a bit an open question for me right here and now. I don't have really a strong view. Of course, I mean, if you're watching yen, like for instance, watch these things as well. Watch the energy, because Japan is still a very big energy producer. Kishida has ordered the restart of 9 nuclear reactors, but those things takes months to really, literally months and months to come back online, because of after the big quake, the safety measures have been ramped up so much that they can't just restart them and go in a couple of weeks. It really takes months. So energy will still impact the yen as well. Okay, then quickly moving over. So yeah, I was actually on the dollar. No, the dollar yen, I've covered it. Yeah, when I was saying on the chat as well, and earlier in the on the flow show, that carry trades seem to have come back, and that I think has to do with those yields, all the G7, G11 yields moving a bit in tandem. They have been driving the whole thing. So, for instance, the one that I'm still tiny short of it, but I failed to add on this scare because I was on holiday. I didn't trade at all. But then we've seen this early August scare on risk and on the lower interest rates globally. But since then, the carry trades, this is versus euro, because euro doesn't know where to really take its clues from now. But if you look at the euro mix, this thing came all the way back down from when we had the scare early last week. I'm still bearish on it. I still think the carry trade is going to be something that is going to stay alive for a while, unless inflation really starts to come down dramatically fast. Then people who do carry trades will have to think twice about keeping their positions open. But for the time being, I still think the carry trades are something to have a clear look at. I haven't charted it, but I think this one is going to show exactly what I mean. If you look at the MEX yen, it came back towards that June low, and since then we've done 636 to 667. We have done like well, the same basically. Yeah, that's about 30. No, 50, no, 5%. It's about a 5% move here. Yeah, it's about a 5% move. So the carry trade isn't dead yet, in my opinion. I'll be slowly looking to reload that. Look, for the time being, I'm gonna need to catch up on a few more stuff tomorrow. I'm probably be able to look deeper into whatever is going on. But unless you have anything to add, Stelios, Steve, maybe we can call it a day for now. And
yeah, that's fine by me. Steve is gone, but
okay.
yeah, I don't have much else to say. I think that was a good coverage, and good to have you back, man.
Thank you very much. Likewise, good to be back on the team with you guys. Good to be back with all our followers and audience and listeners. I hope it helps you in your day-to-day approach to the markets. And well,
We'll
let's
see you later on F.A.C.E. Yep. Thank you, man.
Cheers, mate.